Welcome and thank you for joining us tonight. My name is Marcia Zappa. I'm the Director of Marketing and Business Development at Affiance Financial. For those of you who joined our market volatility calls this spring, I'm sure you've already noticed that tonight's event is a little different. We have some visuals tonight. So if you are joining with the intent of just listening, please know that tonight's event will be recorded and the video will be on our website and shared via email over the coming days. We do have time prepared for questions at the end of the presentation. Due to the large number of people on this call, we are going to use Zoom's Q&A function to facilitate the questions. So please submit your questions at any time during the presentation. I will be monitoring the questions and do my best to facilitate live answers. If we are unable to answer your questions during the call, we will try to follow up, but please also do not hesitate to reach out to your advisor. So let's get started tonight. Kicking us off is Principal and Financial Planner, Andy Fishman.
Thank you, Marcia. Appreciate all the work you and Keely have done. Well, welcome back, everyone. This is again a unique experience for all of us conducting these meetings on Zoom, which many of us have done. I believe everyone can see me. I can't really see everybody, but that is okay. It works that way. I just felt I had a couple of pieces of information on my mind, and I just wanted to give a few remarks before I turn it over to our speakers here. So again, welcome back, everyone. It's been a few months since we've done this. For nearly 26 years, I've been coaching clients, and I've noticed that everyone has a common goal: to have great relationships with family and friends, and to create solutions to reach all of their financial goals. However, today, we want to provide an update on the markets and the economic landscape. This is difficult to do as we look outward to the areas of life that are broken. As I thought about the economic recovery, I realized this may not seem like a typical recovery. We are in the midst of an economic transition, and we need to solve three areas of importance: income, wealth, and uncertainty. Without spending too much time on each, and the guys will talk further about that, we need to just realize that income is job loss, or it's job loss and profits from business, particularly small businesses. The wages have been lost. The fiscal stimulus that happened in March and April helped solve this temporarily. Wealth is the stocks, the bonds, the cash, and the real estate that we own. And many of us, this has been a boom. It has been led by technology stocks, and the market has done very well as we sit here today. Big businesses thrived, and the small businesses have not. The uncertainty: how will the recovery happen? We have an election that will tell us how this may happen. We have COVID-19 that is still not entirely under control, and the virus must be solved for our economic recovery to be solved. The recovery. This will happen. We ultimately may have a reallocation of jobs and where we live and where we play. The virus has controlled how we react in our lives. This shall pass, and the recovery will happen, albeit it may be slower. So I want to pass it on for a little bit more details to Mark Usum, our Director of Trading and Financial Planning, and a Principal and Chief Investment Officer, Seth Meisler. These guys have put a lot of work into the various slides that you're going to get to see and the commentary that they're going to provide. It's good, solid information. And once we're done, as Marcia said, we'll open it up for some questions, and please use the chat room. Thank you. You guys take it away.
So thank you very much, Andy. What you so eloquently described in 5 minutes, we'll have a long-winded way of saying much of the same in 30 plus minutes or so. But with charts and repetition is usually good, at least for me. It's hard to believe. We got together last in May, and in many respects, it has been, doesn't feel like it's been that long. And in other respects, it feels like it's been an eternity. Um, it's hard to believe that we're still working from our homes, and that in the meantime, I got a puppy. And so we are in that, we are one of the many COVID statistics. And we'll talk about the way money is going in interesting ways in 2020 that's different than what's been previously, what we're previously used to. Before we start, we do need to do some required disclosures. And Mark, you have the honors.
I will read the important disclosure information, which is, please remember, there can be no assurance that the content made reference to directly or indirectly in this market commentary discussion will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and or applicable laws, the content is only reflective of our current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in this market commentary discussion serves as the receipt of or as the substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. It's much more pleasant than the pharmaceutical disclosures.
All right, thank you. So we're going to just take a step back and make sure that everyone's on the same page, and we're starting kind of with an understanding of what's going on and what's happened. So we're still in a global pandemic, 33 million cases worldwide, and we're going to show you here why this is not normal. This is not a normal business cycle as what we're used to. Not to say that we haven't had pandemics in the past, but certainly it's been well over 100 years since we've had something like this. How has the response been? Well, you know that there's been an economic shutdown, and that impact has really been uneven. In particular, low income and blue collar have been disproportionately affected, and certain industries have been disproportionately affected: travel, entertainment, and hospitality. There's also been a huge response. The Federal Reserve has responded very robustly, dropping interest rates, increasing their balance sheet, and we'll talk about that, as well as the government has responded through literally sending people money, as well as the CARES Act. And we'll talk about that a little bit as well. And where do we go from here?
So first, we'll focus a little on the issue. So clearly, COVID-19 is the issue. And this graph shows the worldwide cases and the growth in COVID. And we can see the big spike early in the spring, in March, and then sort of a plateau. And I think that could be kind of a testing and reporting issue, but clearly people were aware of this on a worldwide basis, and then crept up pretty consistently through most of the summer until late July, and is again sort of plateaued, but at a fairly high level. We are still seeing 250 to 300,000 cases per day on a global basis. And we are over 33.5 million cases on a worldwide basis. So it's a pretty big deal, and it's global.
And it's a pretty big deal in the United States as well. Here is COVID cases just in the United States. And you can see three major spikes. The first one is back in March, when we became aware and really understood like how contagious this virus is. That then started leveling off as we started with the economic shutdown and social distancing until June. And until I saw this graph, I didn't realize like how dramatic and how much of an issue it was. This was, if you recall, back in the Sun Belt states when their social restrictions were easing. And look at the dramatic increase in cases from 2 million to well over 6 million, reaching up to close to 7 million people in number of cases. That then created further social distancing and economic shutdown until we reached the fall. And then we've seen a spike up, a little smaller spike up in the fall. A lot of that is due to kids returning to high schools, elementary schools, and colleges.
7 million people, it's a pretty big number. It's like every single person in New York, right? Like if every single person had it. So pretty astounding. So this is a global pandemic, not a normal business cycle, right? So this isn't sort of, oh, things got overheated and we raised rates and things slowed down a little. This was governments across the world saying, shut everything down now. We need to protect people from this virus. So very different situation. And we can see this is the GDP for countries across the world for 2019, 20, and 21. And the dark bars pointing down are the expectations for GDP growth across the country this year. Uniformly negative, really, across the world, and an unprecedented global coordination of shutdowns. And I think, you know, the thing that's scary about it is how far down it went this year. So over 4% on a worldwide basis for the year. The other side, though, is the expectations for next year. The blue bars that point up are that there's an expectation of recovery next year. Maybe we don't know exactly when or how much, but overall, across the world, people do expect things to be better next year. The one other thing I'd point out, I guess, is China. And so while we know this virus started in China and had a significant impact on the country, nonetheless, the expectation is that GDP will actually still grow in China this year. Pretty remarkable that even though it was a big deal, they were able to contain it more than other countries were and continue to grow even in that case.
In the United States, what you can see is the change in GDP was pretty dramatic. And you could call it just falling off a cliff. The numbers are a little bit quirky because of the fact that they are annualized. But I think that the bottom line is that you can just get a sense of the dramatic stop in economic activity in the United States in 2020. And that's had significant ramifications in economic activity and in corporate activity. More so in, again, the smaller companies and those companies and entertainment and hospitality.
Yeah, keeping on that track, let's take a look at the uneven impact on industry. This is a slide showing the travel industry and airlines in particular. So this is the TSA data, how many people are traveling on airplanes every day. And we know before the pandemic, 2.4 million people on average traveled by plane in a day. Now that dropped dramatically, and this starts at the end of April at 154,000 passengers. That's it in April. And then started to grow gradually as people got, I guess, maybe a little less afraid or a little less, a little more prepared with PPE and masks and things, and started to fly again. And again, increased about July, but then plateaued again. And surprisingly, we haven't seen that continued trend up. It's been really flat for this industry since July. And we've heard the impact, right? At only 700,000 people traveling a day, about a quarter of the prior capacity and travel ship. We just know that the industry is suffering, and they've announced some of the layoffs and furloughs and things like that. So we know how hard that industry's been hit.
Yeah, there was a recent article that it's going to affect aircraft manufacturing for like the next decade. And again, as we talked about, this has been really uneven. This is an example of Netflix users, one of the beneficiaries of the pandemic and staying at home. And it's really dramatic. I mean, going back to 2011, where there was about 20 million subscribers, and rising in 2019 to 60 million. So in about 8-9 years, you had a threefold increase. But then look what happens in 2020. Goes from 60 million to well over 70 million subscribers in literally half a year. So some dramatic increases in usage. And that's not only in Netflix, other technology companies as well. Amazon has also been a beneficiary. Recently, Amazon knocked on our door wondering if we were okay, as they hadn't delivered anything at our house for a couple of days in a row. So definitely, it's been an unusual economy, and there's certainly been some winners and losers.
Now we talked about a bit about the response, and the Fed was early and quick to respond to the pandemic, and we can see this in the federal funds rate, the rate they charge other banks to borrow from the Fed. And we know that through the last several years, they had been raising the federal funds rate through 2019. And when the market fell in early 19, they started to cut rates again. And we saw then in beginning of 2020, when they shut down the economy, the Fed was very quick to cut rates by 150 basis points back to their lows from 2008, 2009 of just 0.25% or 25 basis points. Now, after 2008, 2009, it was at those levels for a very long time. I don't expect it'll stay down that long at this point, but they've said they're going to keep rates low for the next several years. This is important because it really helps stimulate the economy. They know that lower rates help businesses borrow and operate at better margins. It also helps the housing market, making housing more affordable. And so it is a stimulus to the economy, both domestically as well as globally to some extent, because many other people borrow at rates that are determined by the Fed as well.
That's not the only thing that the Federal Reserve did. The other thing is that they increased their balance sheet by buying bonds. And you can see on this longer chart going back to the days of 2008 and looking at the balance sheet of the Federal Reserve where it was at roughly about $1 trillion. And then you have these large increases in the balance sheet of the Federal Reserve as it was doing what was called quantitative easing. And they did this QE1, QE2, QE3. Going into 2018, the Federal Reserve not only was dropping interest rates, but they're also trying to reduce their balance sheet. And you can see it sloping downward going into 2020. They were doing it at a very gradual pace. But then look what happens in 2020. This is just amazing in terms of increasing its balance sheet from a little less than $4 trillion to over $6.5 trillion. I mean, just a massive amount of liquidity entered into the system.
I think the other thing to just keep in mind is the Fed has a lot of tools. These are two that we're showing, the quantitative easing and interest rates, but they can do other things, and they have actually by purchasing bonds in the open market, corporate bonds, which they'd never done before. They have more tools as well, but these are just two of the ones that we highlight because they're so dramatic. So the government responded in addition to the Fed, and they responded quickly in different phases. So in the early part of March, started trickling out a few billion here and a few billion there, and quickly found they were going to need to do a lot more quickly. And to their credit, in just a few weeks, they passed the CARES Act, Coronavirus Aid Relief and Economic Security Act. Most people are familiar with the CARES Act because you got a check in the mail. They mailed checks to every family, helicopter money, if you will, they call it. They also increased Social Security insurance by adding the $600 per week additional insurance. They added PPP loans. There was a whole set of different things that they added in this $2.2 trillion package. Along with the Fed's package, $4.5 to $5 trillion were moved into the economy in a very short period of time to help what they knew would be this hole that they had created by shutting things down. In fact, there was a phase 3.5 where they added another almost $400 billion to the PPP program and others to help support small businesses that they know, again, are hurting. Now, phase 4 was initially called the HEROES Act, was passed by the House back in May. They've been sort of still trying to negotiate back and forth to get something passed in the Senate. And recently we heard that it looks like that's on hold, at least for now, until the election.
So how's the stock market reacted to what's been going on? It's been pretty dramatic. And that is looking at February 19th, when it really became clear what was happening in terms of COVID and the spread. Over a little over a month, the market declined by 34%, just a really dramatic drop in a 1 month period. In fact, when we were doing our research on this and thinking about this, and even assuming that we had 1 year of no revenue, our estimates for a decline in prices based on bottoms up research was much less than the 34% decline. So really very, very quickly, decline as people got scared. Then look what happens in the second half of this chart. And that is from March 23rd to September 2nd, a 60% increase in the S&P 500, going greater than it was at the beginning of the year and even greater than it was at the high of February 19th. Really just a dramatic shift from one period to the next. Now in September, we have had a pullback in the markets. And whether that's a combination of COVID or election related, really hard to say. But still, even with the September pullback, it's still a dramatic change from where we were back in March. So the question is the following. Why did the market bounce back? If you think about it, the number of COVID cases we have today is significantly greater than it was back in March 23rd. And we're still getting 250,000 cases a day of new COVID cases. The economy is certainly not reopened, and it's been partially reopened, but is nowhere near where it was. The Federal Reserve recently said that they're not increasing their stimulus, so stimulus has been done. Government stimulus appears to have ended, and unemployment is still high, close to 8%, and that's factoring in the number of people who've dropped out of even looking for a job. So the question is, what's going on? Why did the market bounce back?
Well, there are some good reasons for the market to bounce back. So one is just that lower interest rates. The drop in interest rates leads to higher valuation in stocks and in housing. So stocks are basically valued on their future cash flows discounted back to today at an interest rate. And the lower that interest rate is, the higher the value of the stocks are. So just by definition, lower rates do tend to lead to higher stock prices. The housing market as well benefits from low rates, making housing more affordable. Again, we have some of the lowest mortgage rates now that we've ever seen, and existing home sales hit a 14-year high recently. So definitely positives from the interest rate side. Now there's a flip side that's kind of strange, which is, now bond yields are at historic lows, right? The 10-year treasury yields maybe 75 basis points or 0.75%, which is pretty low, right? So with bonds at very low yields, stocks look relatively attractive to bonds. Now, particularly somebody that is looking at yield, for example, might say, look, I've got a stock yielding 1.5%, 2.5%. Looks pretty good relative to bonds even today. That's another potential reason. The other is future growth of some tech-related companies in the less capital-intensive areas allow for faster growth, right? But software in particular, where many people hadn't heard of Zoom a year ago, and Zoom went from a few thousand customers to a few million customers in a very short period of time, something you could never do in a traditional manufacturing environment in that span of time. The marginal cost of sending out that next download or that next piece of software when it's all electronic is extremely low, almost zero. So some of these companies that can benefit very quickly. There's also the temporal nature of the pandemic, meaning the market's not just looking at what's happened right now, what's happening on the ground today. It's looking past today. It's looking out to the next 12 to 18 months and looking forward to a cure. And we know that ultimately we believe a virus is the key to getting things back to normal. And the market's looking forward to 2021 and that being distributed sometime next year. Even if it's announced by the end of this year, we know it's going to take time for it to get distributed. And I think that's another piece that the market's looking through this saying, yeah, we're going to get through this and things are going to be okay, going forward. The other is, while some industries have suffered, the crisis has benefited large global tech companies, which are already the largest sector of the S&P 500. So even going into this year, the largest tech companies in the S&P 500 were driving the index, and it even got accelerated as these companies actually benefited to a large extent from the pandemic. So let's take a look at that quickly. Just as a comparison, the concentration of the top S&P 500 companies going back to the late 90s. And you can see toward 2000, the top companies got very concentrated again. up to 26% of the S&P 500 was concentrated in the top 10 companies, although the makeup was different at that point in time. There were some other companies that you may have remembered called like General Electric and Walmart and things like that. Today it's shifted, right? Technology is driving the market today, and many of these top companies are household names. Apple, Microsoft, Amazon, Facebook, the FANG stocks, Google, which is now called Alphabet, and a few others that you might not guess are there, such as Berkshire, Johnson & Johnson, Procter & Gamble, and Visa. Nonetheless, these companies have disproportionately benefited really from the pandemic.
The other thing is that excluding those top 10 companies, the market returns would be flat to negative.
Right, they've really held up the market.
So what does the recovery look like? And we've heard a lot of letters. This is, I don't know, the Sesame Street economy or something. And that is that you have a V, a U, a W, a K, a Nike swoosh, a check mark. And a couple things. So first of all, I think what's really important to note is that regardless of what letter or symbol the proposal is, the end result is that the end is higher or as high as the beginning. And you can see that pretty much across the board. The one notable exception is K, and which did get brought up in the presidential debates even. And the K is really saying that the economy is going up for some people and going down for others. So that's what they're trying to say by the letter K. But when it comes to the stock market, I think by and large, what we're looking at is a rising stock market. We do believe this pandemic will have an end and that the market will continue to grow on a global basis, as it has done in the past.
So what's ahead? What's ahead? So Tuesday, November 3rd, the US presidential election is ahead of us. And what might we expect as we approach the election of the 46th president of the United States?
So there's been a lot of thought with regards to who will be elected president, and a lot of prognosticators are out there suggesting that. And what does this mean to markets? And we'll give you some thoughts on that. You know, when it comes to a lot of the research that we do with elections and market cycles and stock markets, et cetera, we tend to look at history. And so there's a little bit of humility in that. Again, we're looking at the results, and we know that history doesn't repeat itself, but it does rhyme. And so this is not a prediction of who's going to win or who's going to lose, or certainly a bias towards any one candidate or party than the other. We're just trying to give you food for thought in terms of what is the relationship between parties and the stock market. So the first thing is, how good of a predictor is the stock market for presidential elections? And the sample size is pretty small. We're looking at 23 elections going back to 1936, where the incumbent was running against the candidate. And we find that the stock market has been a reasonable predictor. In 20 out of 23 cases, the stock market was able to predict the winner of the election. And that was that if the stock market dropped between August to November, to election day, then the incumbent generally lost. And if the stock market rose between August to election day, then the incumbent generally won. So how have we done so far? August, the market was up. September, the market was down. October, we don't know. So again, no prediction yet in terms of who is likely to win, but just an interesting factoid.
So another piece of information is we know markets tend to be more volatile leading up to an election. Now this volatility tends to be concentrated in the early part of the year around primaries, and we know the early part of this year is no comparison to history. With the COVID pandemic and the shutdown, I don't think it's a great comparison. Nonetheless, we can see that as we approach the election from midsummer through November, things do tend to be quite volatile. And then after election day, tend to become a little less so. I guess one of the things we can say is that as the markets learn who the president will be, that uncertainty kind of goes away. Markets hate that uncertainty, and it tends to lead to a little smoother ride. In both cases, in both non-election years and in election years, we do see, though, that markets do tend to trend higher. both to and through Election Day. So one of the things we get asked a lot are, well, does it make a difference if we have a Democratic president or Republican president?
Yeah, so going back to the 30s, we've seen that we've had 7 Democratic presidents and 7 Republican presidents. And in almost all the cases, the end result has been that the market has gone up, regardless of which party has been president. So our general feeling is that there's not a lot of correlation between the stock market and the political party of the president. In general, we think that presidents probably get too much credit and too much blame, and instead think of the long term, and that is that, again, markets tend to rise as the economy tends to grow, regardless of political affiliation.
One of the other questions we get a lot is, hey, well, what happens if we get a Democratic president and a Republican Congress, or vice versa? What if it's a unified government? And these questions come up a lot because I think we feel like it should have an impact. The data shows that it doesn't matter that much. So whether it's a unified government, the long-term average return of the stock market during that period is 10%, which happens to match the long-term return of stocks overall. If it's a split Congress, we see the same result just about, and then a little less if the president and Congress are opposite parties. Not a lot less, but these are long time periods. And so we can see that in all cases, markets do tend to do well, no matter whether the president and Congress are the same or divided.
So one of the things that's unusual about this election is the conversation about it potentially being contested. And certainly we know that there's going to be a number of mail-in votes because of the pandemic. And our opinion is that there's a reasonable chance that the election will not be decided on November 3rd, as it will take some time to count the votes. Just a couple dates that I think are important for listeners to know, and that is that states are not required to certify elections on November 3rd. All the counts need to be certified by December 8th, so there's some time given to the states to do the full count. And then the Electoral College doesn't vote until December 14th. So going back to 2000, if you remember, with Florida and hanging chads, the Supreme Court ended up deciding on the case on December 12th of 2000. So what happened in that period of time? Again, we only have a sample size of 1. I complained before about 23 cases being a sample size too small, and here's 1. In that scenario, we saw the market drop 11.6%. A 70-30 portfolio would fall about 7.5%. And we think it's a case of, again, uncertainty. Markets don't like uncertainty. And in a short period of time, as this is all getting sorted out, there is a possibility that the market may not react well to that potentially contested election.
Of course, there's correlation and causation, like you said, Seth. You know, sample size of 1. This was also near the height of the dot-com boom and things rolling over after that. So hard to say exactly what the reason is. But we do know one thing: investors tend to get more conservative in an election year. So this is empirical data from 1992 to 2020, and we see that in election years, people tend to put more money into money market funds than equity funds, quite a bit more, in fact. And in the year after the election, it tends to flip, and they put much more money back into equity funds than in money market funds. That probably reflects a lot of what we were talking about before, is people get nervous going into the election, not knowing that uncertainty is scary, and people tend to get more conservative and put more money into money market funds, and then flip once they're more confident that they know what the future looks like. So is that a good idea?
The short answer is no, it's not a good idea. While it would be nice if we had a crystal ball, or if we had tomorrow's newspaper today, unfortunately, we don't know what the future is going to bring. And so we have this test of looking at 4-year election cycles going back to 1932, and looking at different situations of sitting on the sidelines, dollar cost averaging, or staying fully invested. And while we can't say that any of the other strategies don't work, because they do on small occasions, the overwhelming choice is staying fully invested and staying in the markets tends to provide the best outcome the vast majority of the time. As such, our recommendation is to stay fully invested through the full election cycle, despite the level of uncertainty that you may have.
So given all this, what are some of the things to consider today? So we know that low rates are a tax on savers. Savings accounts earn almost nothing, if not nothing, and bonds are yielding very little. So one of the things to consider is that you may need to save more than you did before because rates are so low. Sort of the flip side of that is be careful stretching for yield and risk. Because rates are low, people may want to try to move down the credit quality side of the bond structures, going from maybe a government bond to a corporate bond, or from a corporate bond to a high yield bond, increasing that risk to pick up some more yield. And we would just say, be careful with that. Stay disciplined with your investment objectives and make sure that your risk capacity allows for any additional risk you may be taking on.
Yeah, and Mark, you would agree. I mean, this year has been just a tremendous year for Treasury bonds in particular, due to declining rates. But the future for someone holding a Treasury bond, it's safe to say future returns and certainly yields are going to be nothing like they were in the past.
Well, I agree, Seth, and I think the hard part is timing that. We know rates are at historic lows today. Bonds had a terrific year this year as rates fell, and bond prices and interest rates move in the opposite direction, and so that's really given them a boost this year. We don't expect that going forward. We know the Fed has said they're going to keep rates low, so we don't expect a reversal necessarily anytime soon. But if bonds were to earn their coupons, which again are pretty low, that would probably be a pretty good outcome.
So we do think it's really important to review your asset allocation, look at your risk tolerance. This last 10 months or 9 months has been just a really good case study in terms of how comfortable are you with risk. It was scary back in March. And so we want to make sure that you're in an asset allocation that you can stick with it in good times and in the bad times.
One of the other things we can do is test your retirement plans for market volatility and rates of return. So for many people where we are looking at retirement planning, we're running some scenarios. We use something called a Monte Carlo simulation, which stress tests portfolio returns up and down over different levels of volatility and rates of return. And that's a place where we can do more work if you need some more assurance that your plan is on track. Maybe try a lower rate of return, a higher volatility, and make sure your plans still work in different market scenarios.
We also think it's really critical to have adequate cash on hand, have emergency reserves, or if you're in withdrawal mode, required minimum distributions, making sure you have sufficient cash. We certainly do that all the time with clients that we're meeting with. And we want to make sure that you are not in a position where you are forced to sell something that has declined in price temporarily. That's not what we want to accomplish. We know that cash is earning nothing, but still we find that it is really important to have. Cash is very desired when no one has it and everyone needs it.
Another thing to consider is refinancing your mortgage. We know mortgage rates are at all-time lows. Again, about 2 7/8 on 30-year mortgages today. This is a great time to talk to your banker, talk to your mortgage broker, and if you have a mortgage interest rate in the high 3s or 4%, highly recommend looking at refinancing your mortgage at this time. If you need a name or a reference, give us a call and we can help with that too.
And finally, I have a personal bias on this one, and that is that tax rates are low today. By historical measures, they're some of the lowest in history. We know that the current tax rates as they stand are set to expire in 2026. And we don't know if tax rates are going to change in the future. Take advantage of today's low tax rates and consider converting IRAs to Roth IRAs. Make Roth 401k contributions, harvest capital gains. Look at what you can do to move assets into a tax-free status, and that will reduce your future tax bill when tax rates could be going up. Again, no guarantees that tax rates are going up, but I think there's a tremendous opportunity now to create tax-free compound growth that will really make tremendous improvements in the plan. So with that, we are happy to answer any questions you may have.
All right, thank you so much, Seth and Mark. We are waiting for those questions to roll in, so please don't be shy. In the meantime, I have a question. Mark, you mentioned the technology, the big global tech companies that are actually benefiting from the pandemic. Do you see any kind of a tech bubble or major market correction after the pandemic as people move away from such intense tech use?
Oh, good question, Marcia. Thank you. I guess we know that tech companies have definitely increased in price and in value. They are richly valued today. I do believe we'll see a deceleration once we sort of get back to normal in the adoption rate. Clearly, we went from 0 to pedal to the metal for a period of time, and that really boosted the tech companies' growth. And I do expect that to slow going forward, but I do think we've had a sort of secular change in how people use technology. We found that we can be pretty effective being remote, whether it's Zoom, whether it's Google Meet, whether it's Microsoft Teams. All these programs have really exploded, and our ability to work remotely has changed, in both our ability and desire to some extent. So I do think the adoption rate will stay fairly high. And so while we may see that growth slow a bit over the next several years, I do expect adoption to continue to be pretty high. And there's still a lot of room for growth in those companies. That doesn't mean there couldn't be a correction at some point along the way.
Great, thanks, Mark. Another question that I'm wondering about. You, Seth, you mentioned the next stimulus package, and that it seems to be taking a surprisingly long time. How big of an impact do you think further delays could have?
Yeah, so I want to try and be apolitical about this. I do think that a stimulus package would be good for the economy, for a lot of those hard-hit sectors of the economy. That has been echoed by the Federal Reserve, by Jerome Powell. And so the actual magnitude of the impact, I'm not sure I know, but I think directionally, it would be very helpful for some additional support for those industries that are really struggling. It would be good for the economy in the long term as well, even taking on that additional debt.
Okay, thanks. Mark, did you have anything to contribute to that?
Oh, I agree. I mean, I think that we're not out of the woods yet necessarily from an economic perspective, and so I do think additional stimulus is warranted. Timing, I think, is important because as we know, some of that ended at the end of July, and so I think the sooner things can move forward on that basis, the better.
Okay, Mark, how do you see the U.S. stock market responding to worldwide containment of COVID whenever it comes in relationship to the various overseas markets?
Well, I do think that, I think this is a question of, hey, when we get a vaccine, what's going to happen, right? What happens to markets, and is there a benefit to U.S. versus global necessarily? I think the short answer is actually yes. The U.S. continues to benefit disproportionately from that. I think that international stocks, it depends on where you are, what you hold. It's more selective. I think China is an outlier in that, and that China definitely also benefits disproportionately to the rest of the emerging markets. But in general, I do believe that the US benefits disproportionately to international markets, although it will benefit all markets.
Okay, and this is pretty speculative, but kind of on the flip side, our clients would like to know what you think might happen if we see another major spike in COVID cases.
Mark, do you want to?
Well, go ahead.
I think that certainly is in the realm of possibilities of another spike in COVID cases. I think we are currently in like the worst of all worlds in terms of having a much longer economic shutdown than we originally projected, as well as an increase in COVID cases. And whether it could be tamped down even more, the number of COVID cases, and if we shut down even further for a shorter period of time, could we get better? I guess the jury's out on that. Certainly there's a lot of debate on that. I think another spike up would be harmful. I mean, I think that will scare people more. The winter is going to be, I think, much more difficult than it has been in the summer, where people could get out. But again, I think that it will end. It will get there. There is an end to this. We don't know exactly when it will be, but it certainly will happen. And when that happens, the economy will pick back up, because again, it's an external source. It's a very different type of slowdown we've had currently than what we've had in the past.
Okay.
I would just echo that, and just that, we saw back in March and April how dramatic market changes can be in such short periods of time. And so I think it is important to keep in mind that while we want to have some semblance of certainty about the future, we just don't have that today. And that generally the best course of action is kind of what we said, is staying invested, keeping with your plan, making sure you have enough cash. It sounds a little repetitive, but at the end of the day, we know that in mid-March, it was scary, right? Things were going down fast. Now, we actually had a plan. We actually rebalanced clients' portfolios at that point, which was very beneficial. We also did some tax loss harvesting. So we're doing things along the way to benefit as best we can, but we know we can't really predict the future. So having that plan in place, sticking with that plan is critical. And we know that, if you had said, look, I'm scared at the end of March, and you decided to sit on the sidelines, you missed the 100 best days in the market. I mean, in history. Now, we would have never predicted that, right? So it's just hard really to know what the future holds. And so sticking with that plan is so critical.
Thanks, Mark. And what about sectors? Are there any sectors in the investment world that you are currently concerned about?
Yeah, so I would say first, generally speaking, we tend to be careful about the sectors in terms of letting a lot of the managers make those specific decisions. Clearly, we showed in the travel hospitality industry that has, what is that? 80% decline in number of travelers. I mean, that is just tremendous. Certainly in oil and gas, when's the last time many of our listeners filled up their car, their tank of gas? Those kind of things we think are going to have long-lasting ramifications. And so those kind of sectors, which we talked about earlier, the travel, entertainment, hospitality, leisure, energy, a number of those, at least in the short period of time, look concerning. But again, that's during the pandemic. That is not necessarily the case afterwards.
Thank you. One of our clients is wondering about the house buying statistics that we've been seeing in the news, and whether either of you had any insight as to what might be behind the boom in housing.
Well, I think we mentioned a couple of things, right? So low interest rates is the biggest single factor. So, with rates dropping by 1.5%, you saw mortgage rates drop roughly by the same amount. So at 2 7/8, it's the lowest mortgage rate you've seen really in history, and that has driven home buying and refinancing. And if you look at what they call the affordability index, it also impacts that. So meaning you can afford to get into a house if you weren't in one before, and if you were in one, you can probably afford a bigger one. So it really drives much of that market by that single statistic. The other issue is that people still move. There's sort of a natural cycle in the economy of people that have to move for different reasons. And the supply of homes is actually declined. And so that's one of the things that's also driven housing prices, which you think, well, why didn't they fall through the floor? Well, part of it is because a lot of people didn't have to move, and the people that do, there's not as much supply. So again, creates kind of a very interesting scenario in the housing market that's somewhat unique based on what's going on today.
Yeah, and I would say housing has been something that we've been looking at, especially maybe this is the effect of the previous housing crisis going back to 2007, 2009, and the drop in housing, where the rapid increase in housing is a little bit concerning. At the same time, one of the big issues in housing back in 2007, 2009 was loans being given to people who simply could not afford it. We're not seeing that currently. So it's something we're certainly watching. We're watching it. It's not like it was, but certainly it's been an interesting development.
Thanks, Seth. I think we have one more question here. It's wondering about how, if there's a separate mentality within Affiance for those who are in the wealth preservation mode versus those who are taking monthly contributions. Can you speak to that at all?
Yeah, can you just repeat the question again?
Is there a separate mentality among Affiance for those who are in wealth preservation mode, still growing their portfolios versus those who are taking monthly contributions? I guess I'm interpreting this a bit, your final slide, what to do.
Yeah, so I do have some thoughts on that in general. The first thought I have is that is a conversation that's really important to have with your financial advisor. And I really recommend having that conversation, who will know the specifics of your situation and be able to guide you, number one. Okay, now, from a general standpoint, I think it's really important to think about the math of savings versus the math of withdrawals. So what do I mean? In savings mode, returns, it doesn't make a difference between the order of returns. You can have returns of being 5, 3, -2, 20, 11, and flip that all around. And again, this is going back to, I don't know, what is it, elementary school math, but the multiplication rule, the end result is going to be the same. It doesn't make a difference. There is no issue with sequence of returns. When you are withdrawing from the portfolio, sequence of returns is really important. Why? Because if you have a loss early on and you are withdrawing from the portfolio, you are not able to make that back up because that money has been spent. It's gone. As such, the rules related to thinking about savings and thinking about withdrawals are different. And so you really have to keep that in mind in terms of what you're doing. So potentially earlier on, closer to retirement, you may want to think about what do you have, and that goes back to, do you have a cash buffer? Do you have sufficient bonds? Do you have a place to sell in case the market goes down? So that's at least how I think about that. But it's a very critical question to think about as you are approaching retirement, or in the earlier years of retirement in particular.
Okay, great, thank you. And with that, I'm going to give it back to Andy for some final goodbyes.
All right. Well, I want to thank everybody for taking some time out of their day or evening to spend with us. I hope it was informative. I think it was. And I want to thank Mark for your efforts, Seth for your efforts, and of course, Marcia and Keely for coordinating and putting all this together. But in addition, we want to thank all of our advisors and our entire team at Affiance Financial. So again, a heartfelt thanks to all. But most importantly, thank you as clients for allowing us to be a part of your life. And we will continue to work hard to live up to all of your requirements and questions. So thank you again. Everyone have a good evening, and heartfelt thanks from all the Affiance team members.
Thank you.
Thanks, Andy.
You have a great night, everyone.
Thank you.